Good morning, good morning, good morning, everyone. Welcome to Community Space Financial Literacy. My name is Aaliyah, and I will be your host for today. We're going to be going over access to capital, specifically the topic of exit planning. Without further ado, I'm going to introduce our presenter for the day, who is Anthony Gordon. And Anthony, if you don't mind giving us just a brief introduction to who you are.
Yeah. Good morning, everyone. I know a few of you have been here before, so I won't go too long with this, but just a bit of background about who I am for those who haven't been here in the previous sessions. My name is Anthony Gordon. I am a lawyer. But I'm not practicing at the moment, but I am a lawyer. Also have a master's of taxation law. And I practice estate planning for a while. I also practiced corporate commercial law for several years. And then I had my firm. As a firm, I have my I'm a certified financial planner. I'm also, which is more retirement and planning for, some planning for budgeting and retirement. I'm a chartered life underwriter, which has a lot to do with estate planning and creating generational wealth. Certified executor advisor, same thing. Not estate planning there, but I'm also a certified exit planning advisor. And what that is I work with business owners and I identify where they are on a personal financial level. And then we also look at their business and we look at their business as an asset and we structure different exits, which is why I think today's topic is especially fun for me. Hopefully it's for you, but more so, I think it is quite relevant because a lot of times, a lot of people think about starting a business, but don't really think about how they're going to leave that business. And in fact, in many instances, people start a business and don't know how to retire from it or to sell it or, not knowing that there are countless other ways to do it, which is where we're going to talk about exit planning today. So I know Chanel is usually part of it. So when I put this together initially, I thought she was going to be here today, but she's not. But we have Aaliyah with us. So just a bit of background for those who don't know, for 2022 and 2023, I was recognized by World Professional as a 5-star advisor for Ontario. I've been quoted a few times. I've been interviewed a little bit more than a few, several times in the media. I've also been on television, that's media with Steve Paikin. I also have an Amazon best-selling book, The Art of Retirement, and I'm in the process of putting the book together, which I hope to have ready for the fall. So we can look forward to that. Okay, so let's talk about exit planning. And sometimes I put succession planning there because a lot of times people kind of, talk about both and they're interchangeable. When we talk about exit plan, a lot of time people use the word succession planning. Why? Because for a lot of people, it's more of a popular term. Succession planning is not necessarily exit planning, though. It's a little bit different. Let's talk about what succession planning is, then we'll talk about what exit planning is. Succession planning is really creating a structure where if something were to happen to you tomorrow, there are individuals, are there protocols and there are systems in place that would be able to take over your business, right? So for example, and by the way, it doesn't necessarily mean you're going to leave. It could be you get sick. It could be you have a family emergency. It could be a range of other things, but for whatever reason, you cannot be in the business. And because you cannot be in the business, you have essentially what's called a plan B, that if these things were to happen, this is what would happen for my business. So if I get sick, these are the individuals who will take over payroll. These are the individuals who will do this. These are the protocols. Everything is listed in place. And quite frankly, depending on the services you offer and as bigger you get, there will be clients who come to you and ask you about your succession plan. Why? Because if you're delivering something of service that is integral to their business or integral to their lives, they will want to know that if something were to happen to you, I mean, chances may be low, but it may happen. If something were to happen to you, they want to know that this business will continue. So that's one of the biggest reasons a lot of people have succession plans. If you have a business, especially a thriving business, and you don't have those protocols in place, I strongly, strongly, strongly recommend that you do so. And it could start off, at a minimum standpoint of just documenting your processes, recording what you do daily, videotape if you're out, for example, if you're a tradesperson, videotape your what you're doing. That way, if someone has to take it over, they know exactly what to do. Or when you start to scale your business, you have individuals who can come and follow you and almost be like a franchise-like situation, right? Exit planning, though, is moving from different functions and different parts of the business. And we'll talk about the 5 exits, so I won't delve too much on that. But I just want to separate succession planning from exit planning. All right. So why have this in place? Well, there are different reasons why you want to have an exit plan in place. For one is, if you are exiting on your own terms and you haven't planned for it, you may end up paying too much taxes. There are certain tax laws that where you can strategize, you could be strategic and structure your business in such a way that you leave paying minimal amount of taxes, and you could pass this on to your family and not have it be such a huge tax burden when you pass away, right? Or when you even do sell your shares. So that's one of the things. The next one is I have no goals and passions and I'm miserable. This one here. Maybe I should have hung on to the business a bit longer. Not planning for the exit can be a challenge. What do I mean? If you're in a business and you constantly do this thing day in and day out and it becomes part of your identity, even as much as you may find it stressful, when you leave that business from an emotional standpoint, it takes a toll. This is who you are, and a lot of times your identity is tied up in the business. And when you have to leave, and the next day you wake up after you've sold your business or you've transferred it, you realize I have no calls, I have nobody reporting to me, I have no clients. A lot of these people are probably friends, and it leads to an emotional thing. It's the same thing, by the way, that happens with a lot of retirees when they're tied up in their jobs and they say, oh, good, I'm going to retire. When they retire and they have nothing to do, it kind of takes an emotional toll. So having an exit plan and planning what that exit looks like is helpful because from an emotional standpoint, you want to create the structures in place that you have some type of purpose or day-to-day thing that you're doing that drives you after you've left, or it could lead to an emotional toll or potentially even depression, right? Another one is I sold my business for far less than what I wanted. There are ways, and we're going to talk about that today. You could structure your business in such a way that it increases the value before you leave. Now, usually we call this value acceleration. Now, usually you want a good 3 years, but sometime if you need to leave sooner, you could put things in place. But you absolutely want to structure your business in such a way that you increase the value. Another thing was you may not be prepared for selling your business, right? You're not prepared for selling your business. And so when they do the inspection, what happens is it causes a nightmare. And again, I know we're talking about raising to capital. You might be going, what does exit planning and all of this have to place? Exit planning and the structure of an exit plan, for one, increases the value of a business and you have a more proper business, which will be great for raising capital, which next week we will talk about raising capital. And a week after we'll talk about how we present this capital. So exit planning on a whole is great because for one, it increases the value of the business. Or here's another thing. You may very well get this loan, get this money, and something happens. Remember, you still have that outstanding loan. And if your business is not structured the way it should be, and you leave under those circumstances, it could be disastrous from a financial standpoint, right? So I just want to put a context of why exit plan is popular, why exit plan it should be important. I'm always 2 minutes to manage my wealth. I don't have enough money. We're going to talk about today that exit planning. A lot of people think of business with exit planning. Actually, your personal goals is what drives your business goals, which we talked about I think a couple of weeks ago, and that becomes the foundation for the exit plan. So if you haven't taken into consideration your individual situation, that may lead to a disaster overall because you think you're leaving a certain amount of money, but you haven't planned for it. Another thing is structuring your business from an exit planning perspective gives you the balance because you will see that you leave from different exit. Another one is having a proper exit plan allows you to protect your business And that way you prepare for a lot of things. Because one of the first things you do to increase the value of your business is to protect your business. I remember speaking with well, a client of mine, and what was interesting was this client did everything well. She was making millions with her business, and I think a year or two just before she left her business, things went sour with her shareholders. Things were not set up in place, and it actually imploded the business, and it led to a whole bunch of lawsuits. She had to borrow money against her house to pay for the lawsuit, and the business took a dive because, of course, when you have two owners of the business not being on the same page, that is a disaster, right? Another thing is you could be the business owner and you die. What happens to your us? What happens to that business? How's your family going to survive? Right? Do they know how to step in and handle everything? Right? These are the things you have to consider, right? So what is an exit plan? An exit plan answers all business, personal, and financial goals. So it's three-pronged. You look at your personal situation, your business situation, and your financial situation in terms of money, right? Now, when I think of exit planning, this is what it looks like. Because a lot of people think it means that you're just selling your business. Not necessarily. Exit planning meaning you're looking at your business and you're exiting different stages of your business. Now, for some people, there will be more. For others, there'll be a smaller amount. So let me stop first and define the two types of business you usually have. The first one you have is what's called a lifestyle business. The second is more of a performance business, right? And depending on which one you are, your business will be structured differently and your exit will look different, right? The lifestyle business is the business where you have a smaller team, you've built up your business, you're very much involved. You could take off when you want to, but you're doing okay. You're doing well from a financial standpoint, but it's not a large team. We're not getting extra locations. We're not planning to do this big, huge organizations. We're making enough money to pull enough, take enough money home. And you might have some value for the business, but it's probably not as much as it would be for a performance business. So what is a performance business? A performance business is where you have built this business such that the business is you want this thing to grow significantly, like maybe a franchisor with different franchises, or you have a firm or a location and you want to open up all these locations. And at some point, what you're going to be is you're going to be very not in a day-to-day delivery of services. You're really just managing everything at a higher level and not being involved. Where the lifestyle business, you're very much involved. So example of a lifestyle business. Example of a lifestyle business could be a wealth and a financial advisor. In a lot of cases, financial advisors are very much involved in the business. They may have a team that do a lot of the work. They could go off for 2 months and they have their assistants and all the people who do the work, and that's taken care of, but very much they're an integral part of the business. They could transfer that business, but on a day-to-day, they're very much involved. A performance business, that would be a little bit different if you have, for example, a marketing agency, but you are not the one delivering the services. And Aaliyah, okay, good. I was about to say, if you have any questions, let me know. And I just saw that you put that in the chat. So guys, as I go through things, if there are questions, please put them in the chat. And again, no question is too silly. No question is stupid. If you're thinking it, I'm pretty sure a bunch of other people are thinking the same thing, right? So any questions you have, feel free to drop it in. So yeah, please don't be intimidated and think that, you're asking a silly question. Drop it in. Performance business. So for example, you start a marketing agency, but you know nothing about marketing, but you know that it is a great business to be in. And so what you do is you have the money, you hire someone, right? And you hire someone and you have those individuals doing the work. And over time, you build a team. And over time, that team may have, okay, I want to focus for marketing for lawyers. Okay, now that I have that vertical done, let's do marketing for accountants. So you start to expand. And these are the people who want to get 6, 7 figures, really large, and you're trying to increase as much as possible. And you're very much not in the day-to-day, you're overseeing the business, right? So depending on where you are, it will look differently. But this is what it looks like. The first exit is exiting the line. we talked about last week where a lot of people start with a business. They are I am everything. I'm the marketer, the salesperson, I'm delivery, I'm operations, I'm finance. I have all the hats, right? And we recommended that you draw an org chart and you list all the things required. And then after you've listed all the things required in terms of delivery on that org chart, you put your name in every single box. And the one that you're weakest at, you determine, okay, that's the first place I'm exiting. I do not like finance. I do not like all this number stuff and collecting money from people. I need to get somebody to do this, even on a part-time basis or a 1 day or 2 day basis. I am going to do that. And so what you do is you write the description and you record what that person required to do. You hire that person and that person starts to take over. Once you start doing that, you essentially become a manager because you're overseeing this person. This is where you start to exit staff. So you're on front line doing everything. No, you start to delegate a bunch of stuff and you take a managerial role. And at that point, you have somebody else fulfilling that. So now you're exiting the staff. Over time, you may want to exit the org. Now, this is where the difference between a lifestyle business and a performance business comes in place. The lifestyle business, you may never really truly exit staff because from a managerial part of it, you're very much involved. If you're an accountant, if you're financial advisor, it's your name on it. And so there's certain responsibilities. So you can't technically exit staff because you are the person, right? However, if you're building a performance business, and I'll even say, suppose so let's use the marketing agency. At this point, you start off, you hire one person. No, at this point, you even go as much because your business is growing, you start to hire a CEO. That means you essentially are very much not involved in the day-to-day. All you're monitoring is the numbers and you're asking the CEO, okay, where are things going, what's being done, what needs to happen, right? Because at this point, you're really treating this thing like an asset. And essentially you become the board or you have other members there and all the performances, the CEO comes to you and you're asking the questions, right? From there, you could exit the board. You become an investor. That means you're no longer frontline doing the work. You're no longer a manager. You're no longer CEO. You're no longer on the board. You're only an investor. And all these individuals, this is they're reporting to you because you're a shareholder. And that's all you are, a shareholder from a number standpoint, right? But you probably want to keep significant majority shareholders so you could decide if we need to get somebody out of position, you have enough power to do that. And by the way, I know some of you might have smaller business and think, okay, why are we talking about this? Because I think it is important for you to at least know the context or the framework, because why not dream? Why not think about building these businesses? All of these great businesses that have grown to the level they are, this is how they start. At one point, Jeff Bezos and all these guys who you look at as wealthiest people, they were in a garage or in their offices and they had to go through all of this. You may not go all the way, but at least know the framework of that you have a sense of how this thing works, right? So from a strategic standpoint, it's just good business because what we're doing is increasing the value. So now that I've laid the framework for what exit planning is, I'm going to walk you through the process of how you could start doing exit plan. I have a context of giving you a framework of how you could start that in your business, right? So let's start off. As much as we go into business, one of the major reasons people go into business is what? For freedom. Freedom from a boss. You want freedom, you want more time. You want freedom to spend time with your kids. You want the freedom to build something that you're not limited by a paycheck. You want to build as huge as possible, make as much money, and then exit this thing, right? But in order to know what freedom looks like for you, you got to start off with your personal goals. Again, we said that the business is a conduit, an extension of yourself. What are your personal goals? What do you want to achieve in the next 5, 10, 15, 20 years? On a personal level, financially, family, spiritual, all of this. And then what you do next is you look at that personal goal and you see how much money is required for you to attain that. You go, I want to take all summers off and spend it with my kid. All right, cool. I want to have two homes. I want to have a home here in Canada. I want to have a home in Florida. I want to have a home here. I want to have a home in Jamaica. I want to have a home in Trinidad. Whatever your goals are. Or it could be, I want to spend some time here, and the other time I want to just travel the world. Those are personal goals. What is it going to cost for you to get there? If you don't know what it costs for you to get there, how are you ever going to get there if you don't know the cost? It doesn't quite work, right? After we know what the financial goals are, and you typically are going to know the financial goals by doing some type of a financial plan and quantifying this thing. We look at where we are in terms of our financial goal, and then we look at our personal financial assets, right? So we go, this is my goal. This is the value and how much I need. This is how much I personally have now. And then as a business owner, you go, what am I going to use to build to make up that gap? And that's called the wealth gap. That wealth gap we will get from the business. So now when we build our business, I know how much value this business needs to provide me, either from a salary standpoint. I also know what it needs to provide me from a valuation standpoint. And I drive that in terms of from a business standpoint. Now I have direction. Because sometimes you start a business and you go, okay, how much should I earn this year? What should I do? Or this solves that problem and also gives you focus on what you want to build. And this, you could build it bigger than your personal goals, but at a minimum, you want to build this in terms of the business, right? So let's make this up. I'm going to throw some numbers, light numbers, but I had to put this in place so you get a sense of what this thing really looks like. All right. So say your personal goal is, I don't know, you want to have a cottage in summers in Hawaii, right? I know some people like cottages. I'm not necessarily a big fan of that, but hey, some people like it. So you go, I want to have a cottage and I want to spend summers in Hawaii with my family. And I want to do that by a particular age. So you say you want to do that by age 60, right? You go, how much do I need? The financial goal, and you do the numbers, you work it out, you do your financial plan, you sit with your financial planner, you establish this amount. You recognize you need $5 million to achieve this. I know you go, okay, I need $5 million to achieve this. Okay, where am I now? So this is the goal, the long-term goal. It's presently where you are now. Okay, where am I now? You go, well, I only have $1.5 million saved. I'm 50 years old. I have $1.5 million saved. I have 10 years. And my goal is 5 million. So now I know I need to get 3.5 million from this business. So my financial goal minus my personal financial assets. So it was 5 million was my financial goal. My personal assets 1.5. My wealth gap, that is the amount I need to get from my business, is $3.5 million. What does that mean? One way or the other, either through savings or through selling this business, if I really want to live the life I want to live, I need to get 3.5 million from this business. So what am I going to do to close this wealth gap? What am I going to do to get that 3.5? This is where the exit planning strategy comes into place. So the first thing you want to do as a business owner, and I mentioned this a couple of weeks, you want to know the value of your business. And if you're just starting out, you want to know how people value businesses like yours in your sector. And the one way to do that is simply speak to your accountant if you have a good business accountant, or you could speak to a business broker or somebody who does valuation. I mean, I'm pretty sure you could ask a business broker. And if you're hesitant to do it, just say, listen, I'll pay you a couple. How much would it cost for you to just sit with me, do a soft valuation? Because a real business valuation is probably at least $2,000, $3,000. If you don't want to go to that level, you don't have to. But get a business broker and go, listen, I have a business. You know, I know you have access to a lot of this information. I'm just starting out a business. How much would I pay you for an hour for you just to if I tell you my business, you kind of tell me how our business is valued in this sector and potentially what I need to do to increase the value. Here's why this is, by the way, and it's always kind of shocking to me, especially with people who have been in business for a while, that they have no idea the business value. Because think about it, your business becomes your asset, just like you would have. Let me have this, but where can you find a business broker? Oh, a business broker. Okay, good question, Alicia. So a business brokers, they're usually, not usually, you have to have a real estate license. After you have a real estate license, then you could continue to sell a real estate, or over time you could sell businesses. If you Google business broker and areas, you probably haven't searched for it before, but once you Google business brokers locally, there's a ton of them. There's a whole bunch of business brokers. They're all over. They're usually realtors. Well, not usually. They all are realtors because you got to get a realtor license, and then from a realtor license, you could go on to sell businesses just like you sell home. I never really quite got a connection between selling homes and selling businesses, but somehow the industry thought it was that way. So there you go. Yeah. So yeah, no, Alicia, what you're gonna do is you're gonna Google it. You're gonna see them pop up everywhere. It's funny how that works. You might not be introduced to something. I know that you hear it. You're gonna find out all these people that you probably know who are actually business brokers, but just never realize. But yes, so business brokers, have them sit with you and say, listen, I'm building a business. I'm curious to know what is the valuation of this business in this sector. And they will tell you, okay, for your industry, this is how we value business. These are the multiples. These are the things that are best in class. And I'll talk about what best in class is. But essentially, by the way, if you ever want to start a business, before we talk about, because we're talking about, early stage of business. If with all the information that I know now, and I'm going to start a business, I am sitting with a person who is a business broker or somebody who does valuations. Why? I can go to them and go, I'm thinking about doing this business, this business, this business. Based on all the information you have and all the valuation that you have at your fingertips, what industries from these three is the best one to get into? They will tell you right now, the industry that does well is this, the industry that does well is this. Like I could tell you right now, one industry that is going crazy, which is, I never saw this before, was franchises. The franchising industry, the multiples in franchising are going as much as 13 and 18. And I'll talk about what multiples mean. Just know that there are a lot of private equity and big investors from the States who are coming here and going to different countries and buying up, like offering ridiculous amounts of money for franchises, right? So if you want to go in a particular industry, they say, listen, you want to go in this industry? This is a great industry, but I tell you what, franchises are going crazy right now. So you may look to go, this industry plus franchises are going crazy. It may be good for me to get a franchise in an industry and you put them together. It just tells you what the market wants and what the market needs. We spoke about in previous sessions that 42% of why Canadian business owners fail is because there is no product market fit. It's not because they are not skilled, it's because they're not positioned well in the market. And when you have something like this, I speak to a business broker and you get a sense of what the industries are, what has a long-term trajectory, what is growing, what's available. When all these things are at your fingertips and you have knowledge for this, the benefit of that is that you will now have clarity about what decisions you need to make, right? So that's kind of where we start. But anyway, you want to get a value business, just like an individual who works. You go to them and you go, how much money do you have in savings? Oh, my value goes up and down, but I have $500,000 in savings. I have $500,000 in investments, or I have 350, or I have 1.1. You know what your portfolio is doing. So why wouldn't if an individual knows what their portfolio is doing, why wouldn't you want to know what your business is doing, right? It's kind of like the same analogy. So how do you value businesses? Generally speaking, what you have is recurrent EBITDA times a multiple equals a value. All right, what does that mean? If EBITDA is earnings before interest, taxes, depreciation, and amortization. For simplicity, let's just say it's net profit. So a net profit, and I'm going to give you an example. Net profit times the multiple. So you might go, what is a multiple? A multiple is based on how good you are compared to other businesses in your industry. How am I going to know how good I am compared to the business in my industry? This is where the valuation standpoint comes by. You speak to a business broker or a business valuator, and they will tell you where you are. They will say businesses who are good in this industry will, for example, have this size team. They'll have these type of contracts. They'll deliver these type of services. They will not have an individual be so involved in the business, or they will tell you that their customer base, no more than 30%, is responsible for all of their income, right? For all of their revenue. They will say not, they will structure it in such a way where they have standards and procedures. You'll have a list of these things. These things are called value drivers. And the more of these you have in place based on the industry, the higher the multiple is. So for example, let's say your EBITDA is $500,000, $500,000, $500,000. And right now, based on where you are in your industry, your positioned at 2. Multiple, you're gonna get 2. So 2 times $500,000, we have 1 million. So that will be the value of your business. How good you're compared to. Yep, that's correct, Elliot. Yep. Okay, good. Just drop that in. Right. So let's do a deeper dive into multiples. So we know net profit is kind of straightforward. Let's look at what drives multiples. It really is these 4 things usually. Human capital. These are the people you have working in your business. It's the leadership, it's the business size, it's the organization, it is the quality of people, it's the industry recognition. It's how, if you're in an industry that requires certifications, how many people have certifications? It's all the stuff inside. Do you have standards and procedures for your employees? If one person leaves, how does it affect it? It has everything to do with human capital, everything to do with the people working in the business. So how are you, in terms of an individual, training your people, how good they are, or what they do, and what happens if they leave? That is the first one. That's the human capital. The next one is customer capital. What are clients saying about you? Also, what are your client demographics? So you might go, what does my client demographic have to do with anything? Well, suppose your clients are seniors. If your client were seniors, you'd have had challenges just after COVID. Why? Because when inflation increased, so when everything went up, the price of everything went up, and there was huge inflation challenges, seniors who live on fixed income, they started to get rid of a lot of things. And if your business was something that was one of the things you had to make a decision about, then that would affect you from a demographic standpoint, right? So your demographic of your clientele, is it high net worth, low net worth? And it doesn't matter. You just have to know, and you have to know what is the trajectory for this particular industry, right? But a big thing is client experience. How many of your clients are talking about you? How many clients are sharing information? How often are you communicating with your clients? What are the simplest things you could do? And I've done this is, where you have a bunch of clients and you wanna communicate something. If you have a newsletter, it's a simple draft email and send it out. Or even, do you want better than that? Create a video. Something changed in your industry and you create a newsletter, you write all that stuff, you communicate to these individuals. All of these things lead to great client experience. But here's another step. You make it where it's a process within your system that if somebody comes and take it over, that newsletter is already built. You already have the emails. You already have everything in place. That way, whoever takes over can continue, right? So that's the customer capital. Next one is the structural capital. And then these are strategies, systems, processes, price structure, standards, and procedures. By the way, this is what holds businesses together. Because if there's no process, an emergency happens, and one of the person who's integral to the business has to step away from the business or dies or something happens, what happens to the business? In many instances, if it's no structure in place, it falls apart. By the way, which is why franchises have a higher success rate than any other business. because a franchise essentially perfected a model, then sell that model to everyone else, right? It's probably the reason why a lot of big investors are approaching franchisers and providing them with so much money to purchase their businesses because they have 10, 20, 30 years sometimes um, um, record of delivering great profit and being consistent, even when the market and everything else was being affected, they were still delivering things because they systematized everything. All right. So what's the last C? The last one is a social capital. That's brand marketing. This is a bit more harder to measure, but nowadays it's becoming more tied not to just a brand recognition. The value of a business, funny enough, I'm seeing now with all the, because I'm part of different groups and we talk about valuations and everything. Social media followers are starting to be a huge component, at least for a lot of people who are purchasing. They're starting to think of how many followers you have across all platforms. Because where we are, especially after COVID, social media has become such a huge part of profit. I was speaking with a business owner just recently, and she was telling me that, ask her, where do you get leads and, and how you generate your business? And she goes, oh, it's all social media. And I go, it's all social media. And sometimes she does some paid advertisement, no one-on-one. It's like a thing you turn on where she really wants to get it going, where she just pushed out a whole lot of content to a particular page, or she do paid ads and that drives it. So there's something to be said if from a social media standpoint, you have a certain amount of followers, as soon as you push it out, everybody gets that, right? So social capital is another thing. So I think this is becoming a lot more concrete because if you have followers and you push messages out and what you get is a particular response, you can start to train that. 3x represent in this diagram. 3x. Oh, so this is just an example. Good question, Tamara. So this is just an example of how potentially the value, the multiples could look like, right? So we have the 3 C's and then we have the financial statements. This could all be good. You better have at a minimum 3 years worth, clean, good financial statements. By the way, good, clean financial statements mean, folks, you don't have your daughter's ballet class being expense to your company before you sell your business. It means that also from a car, the car that you give to your son, you got to clean that stuff up. I mean, they're gray areas just generally speaking, but especially when you're getting things in order, you want to get that clear, right? So having good, clean financial statements, because when they do due diligence, before they look at all of this, they're going to go, let me see your financial statements. They look at your financial statements and they see what the trajectory, they like a good 3 to 5 years, minimum 3 years, because they kind of get it. They go 4 or 5, they get it. You're cleaning stuff up, right? But this is an example of, for example, the financial statements could be 1 to 2x, meaning the cleaner this thing is, the more trust they have in you. If you have a really good financial statement, in this example, you probably have a 2x. If your financial statement is dodgy and you have to ask questions, you got to get information, you got to substantiate, then you're going, this business is probably good, but I don't know if I could trust the books as much. So I'm going to lower the value just in case there's something I'm missing, something I'm missing. There might be a gap here that I'm missing. So let me lower the value a bit. But here, if you had a 10 out of 10 on human capital, 10 out of 10 on customer capital, the clients love you, 10 out of 10 on processing the system, 10 out of 10 on social capital, and then your financial statements are squeaky clean. In this example, you'd have a 5x. So if you're making 1 million in EBITDA, then you'll be able to sell your business at 5 million, right? No, suppose they look at all of this is good, but they go, I don't trust the financial statement. There's a lot of stuff here that's, this is kind of missing, that's kind of missing. I know the company's making money, but I'm not too sure. I'm going to drop it to 4. I'm going to take away 1x here. So now they're going to negotiate that. And instead of getting a 2x here, you only get 1. So now you go from being able to offer 5 million, now you're offering at 4 million, right? So this is kind of an example of what it would look like. So again, accounting systems are good, and then the actual running of the business. This is how we would consider the valuation part of it. So how do we close this gap? So we talked about these numbers before. 1 second. Okay, yes. So let's 1 sec. Okay, so now that we know the gap, so the first thing is we identify the value of our business, we identify the gap, we see we're at 3.5. So let's walk through the situation where we are going to be closing a gap. And by the way, closing the gap sometimes means we don't have the finances to do it. Good question. Were the EBITDA or the last 3 years that match the financials provided? Okay, great question. Love good questions. Love that. What they will ask for is they'll ask for the EBITDA for the last 3 years. If there are different fluctuations, they take the last 3 years and they will average it out. What they're very, 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 very what should I say? They'll become a little bit skeptical if they see, for example, 3 years ago you did 300,000. 2 years ago you did 500,000, and then last year you did 1.5. They will average it out, but they're going to go, okay, what happened last? Like, am I missing? Like, what happened that you pumped your business to the point of 1.5? And even though it averages out to whatever that number is, you're gonna go, I don't trust it because it's not consistent enough for me. If you did like a 1.5 and a million, I could get it. But you went from like 500,000 to 1.5. You might be doing a lot of stuff here that I'm missing, but I don't know how trustworthy that is and how scalable this is. Or even if you could maintain this, you probably had yourself, or you just got lucky in 1 year. They're going to be skeptical of that. No, they're going to do a deep dive on the books, but at a minimum, what they're going to want is 3 years. During COVID, they asked for 5. No, we're past COVID. They're usually asking for 3 years, and then they take the 3 years and they average out the 3 years, right? But again, if you have an outlier where, especially the year before you did ridiculous amounts, they're going to probably knock that down a bit because they're going to be saying something looks a bit fishy here, all right? Right, so we know that this is 3.5. We want to close this gap. So this is what we do. These are the 5 stages of increasing the value of our business, right? So let's because I don't want you to lose track of this. You have your personal goals. You know, you get that amount down to a financial number, whatever that is. You look at your personal situation and see how much of that can be fulfilled by your personal goals. That gap, the rest of it comes from your business. You look to the business, now we want to increase value. A lot of times when people are growing in business, sometimes they need access capital to do this. And by the way, this is the type of conversation that you'll be having with the bank or a lending institution about what your plans are, right? So it could be you want to increase this business. This is what your plans are. You want to go in first and go, of course, we start off with identifying the value because we know we want 3.5. So we start off, we talk about valuations, we identify the value. The first thing you do to increase the value of your business is to protect your business. You're only as strong as your weakest link, right? So you want to protect your business from personal things first. Death. What happened if you as the owner dies? The bank's going to want to go, okay, we're about to give you 500,000, 300,000, whatever the amount is. What happens if you die? How do we get paid back? Well, Mr. Bank Loaning Officer or Mrs. Bank Loaning Officer, I have a life insurance policy. And if I die, this money goes to my company and they will handle all outstanding debts. And you could show them how structurally you'll do that. They go, okay, great. What about disability? What if you have a disability? Well, I have standards and procedures in my business. I also have a succession plan. If something were to happen to me, this is all instructions and these are all things left in place. Or additionally, I also have disability life insurance. So I will have money coming in. That way I could continue to pay the loan. Okay, I see you have shareholders here. What if you have a divorce and your wife or your husband owns part of the business? How do we deal with that? Well, I have an agreement in place which says that I will need to be bought out And part of that stipulation is that all loans and debts will be taken over by the business. Great. What about health? Well, if I get a stroke or illness or something, I have a critical illness. I think you get where I'm going at with this. These are questions. I know when you go to a bank, you go, okay, here's my numbers, can I get the money? And they go, yeah, but what if you die? What if you get sick? What if you get a divorce? What if you get depression? What if you get critical illness? What if your mom takes ill and you have to go to Kenya for 6 months? These are all things that they've probably seen or experienced at one time or the other. So you have to communicate and tell a story so they feel comfortable in knowing that it's fine and you have thought it through and you have protected it. By the way, from a business standpoint, if you have these things in place, from a valuation standpoint, when somebody looks at your business, it increases the value of your business. Another thing is you got to protect against financial risk, market risk. So sometimes you need to have diversification, protect yourself from lawsuits, right? So you might need to have the proper coverages if needed. You want to have things in place from like a long-term care if you are sick for a long time. You want to think about all these things from a business standpoint, your customers, what's your competitors doing to take away your customers? How are you protecting against that? What key people? That is so huge. You have this one person, he's the salesperson, the top salesperson, delivers 50% of all your results. What if that person gets sick? Or better yet, what if they go start their own business and start to compete against you? How do you defend against that? What are you doing to protect yourself? Right? You may want to put IP in place. You could do a what do you call it? Non-compete, even though those are not as strong as they used to be, but you got to think these things through and know what you're going to do. What if the economy goes bust? You're in a restaurant business. What if you have another COVID? What's your plan B? Right? What if you have a partner disagreement? Right? All these things. What if you get sued? And you got to pay these outrageous lawyer bills. How are you going to deal with that? Right? And this is where you look back at all these things and you see how you could protect them, all the 4Cs, and make sure things are protected. Each of these, the human capital, the customer capital, the structural capital, the social capital, all of these things are protected, right? So, one second. Then we have the value gap analysis. So I like to share this because when a lot of people think, I look at these, a lot of these guys, venture capitals and the private equity guys, and they go in and think it's impossible for you to go into a business and increase the value and have it grow. Let me walk you through what this looks like. And by the way, this is how these guys think. So when I did a certified exit planning advisor, a lot of the people who I did the course with were M&A folks, mergers and acquisitions, private equity, venture capital, family offices, a lot of people from the big wealth firms who deal with a lot of wealthy business owners. And by the way, there is no lack of capital or lack of money. It's just a lack of appeal, meaning people want to invest in businesses. They just don't see the businesses to invest in. And once you understand these mechanics, you can position yourself a lot of time to get investment. So for example, we have this business that has a profit of $600,000, right? And the multiple is 2.5. The value here would be 1.5. This is the value of the business currently. And you go, okay, this is what I'm going to do. This is what I'm going to do. I'm going to get some things together, tighten up my marketing, tighten up my closing ratio. I'm going to get it to 800,000. You got to 800,000. So what you just did is increase the value from 1.5 to 2 million. But look at this, folks. I've talked on this so many times, and it still blows my mind when I think about this. The profit, the EBITDA is 800,000. You could keep the profit the same, meaning your profit for the year is 800,000, but you improve the internal parts of the business. Remember, I mentioned the 4Cs? You improve the internal parts of the business, and it increases the multiples by times 2.5 to 4, and now we are 3.2. We didn't even increase profit. We increased by $1.2 million, even though the profit hasn't increased. This is how a lot of investors go in. Private equity will go into a company and increase the. So how do they increase it by double and triple? This is what they are doing. And this is why it's so important for you to know as a business owner, how am I valuing my business? Like, what are the drivers? What essentially, what do I need to do to increase my multiples from 2.5 to 4? Because you can keep the profit the same, just do some things internally, and your asset goes from 2 million to 1.2 million. Sorry, from 2 million to 3.2 million, which is an increase to 1.2 million, right? So all you've done here is you've improved the business attractiveness and you improve the business valuation. So this is why I say it's so important to know what it takes to improve the value of your business, because you could even keep the profit the same, improve internal things in your business. When you go to sell, that's where you have the opportunity. Here's the other thing that you need to consider. 80% of businesses that go for sale never get sold. And it's not because they don't have money. It's because they were in a condition to be sold. Think about this. If anybody here has ever sold a home, right, you must have known somebody who's selling a home, or you're probably gone to like one of those things where when people stage the houses. You could have a nice home, but you have your kids, you have kids all over the place. They throw someone here, they throw this here, they books here, everything's all over the place. If somebody comes in to buy the house, it's not appealing. You don't want any parts of it. However, if you get somebody to stage that business, put away the kids' stuff, get the things placed, you clean the things up, things are in the right place, it looks amazing. What happens? People go, oh my God, this is my dream home. This is the home I want to buy. And quite frankly, if you're selling the business, you might say the same thing yourself. You go, why am I selling this again? Because you've done so much to improve the business. You got it to improve the house. You got it to the place where, man, it is a dream home that I thought it would be. I just never took a chance to make it that way. So you could do the very same thing for your business and improve the business that way. Now it's at the stage where we did this, we got it to 800. We kept the profit, we increased the multiples. We're at 3.2. Now we go, okay, how do we sell the business? You got to be strategic about that. Whether you're selling it to a business or to a partner, because from a tax standpoint, you want to be, I'm not going to go into a whole tax thing. This is not a place for it. But just know you want to consider how you're selling it. If it's something you want to transfer over to a family member, you could do what's called an estate freeze, meaning you could literally freeze the value of your assets such that your taxes never get passed at a certain amount. And you could transfer the growing shares, the common shares, into your family, and your family gets the benefit from all the growth and the value of that business from the time you've frozen those shares and get taken preferential shares. It's kind of more detail than that, but just know, let's put it this way, just know if you have a value in your business and you're going to get taxed when you sell a business, you can freeze your value. You could freeze your value, still control the business, still get dividends from the business, still get a salary, still have all these things in place, transfer ownership to your family, and your family can benefit from the growth of that business. If you have not done that and you do that too late, you will pay a large amount of taxes, something that you could have prevented, right? If you're doing it to associates and business partner, you also want to be strategic about who you sell the business to, depend on if you want a business to continue. Also for tax purposes, how you structure the payment. Here's another thing. A lot of times people go to sell the business. What do they want from you? They want you to stay on. Maybe you don't want to stay on. Maybe you do. You want to do fine. But if you structure your business in such a way, when you go to harvest the value of your business, you may have it done in such a way they go, well, I want you to stay on. And you go, I don't need to stay on. It goes, yeah, well, you're the owner. You're connected to it. I was like, well, I haven't been in the business. I've been at the workplace for like 4 months. What are you going to pay me to do? Right? And by the way, this is how you know how involved you're in a business. The question will be on a Monday morning, what are you doing in your business? If it is you're talking to clients, you're very much involved. If it should be more along the lines of, hey, I'm talking to the manager, or I'm talking to the CEO, or I'm talking to whoever is in charge, because that way you're not too involved, and then whoever takes over the business can take over the position and do that. Versus if you're talking to clients, you're talking to suppliers, you're at that point, how replaceable are you? You may need to stay in the business for a while and for you to continue and stay in it, right? Here's another thing is, in order to harvest the value and transfer the value of your business, you want to make sure that the business value, the experience that you provide is consistent and it's duplicatable. This also is something when you speak to go from a loan perspective and they ask you what happens if you are no longer in the business. Well, you go, I have all these procedures in place. I've recorded everything. I have all these different, documents. I have all these videos. Everything's documented. If technically I could take off 6 months. I love my job and I love my business, so I'm still involved. I could take off 6 months and other folks could run it, and I could just call and make sure everything's in place. Right? I kind of mentioned the retention clause because sometimes they will say, hey, we'll pay you the value, but if the value of the business drops for a while, it all depends on how many clients we retain. I wanted to mention this one thing that I didn't talk about here. A lot of private equity folks, what they do to move from this to this, and they do it super, super, super quickly, is a subscription model. If you could have a subscription model in your business, it's one of the, other than protecting your value, having a subscription model in your business is one of the fastest ways to increase the valuation of your business. Why? Because month after month, there is a certain amount of revenue that is guaranteed to come in, versus if you don't have a subscription model, you're waking up every month and you got to sell and close stuff, right? So I forgot to mention that. I want to highlight that though. But if you notice, all of these big companies, they create some form of subscription, and what do? They lock you into these 1 year, 2 year, 3 year contracts, right? Especially a lot of software companies. And that's because a lot of times they're doing it for valuation purposes. Okay, let's see what subscription fall under. So subscription model will fall under two things. One, it will be the client experience, and it will also be reflected in financial statements. Because the customer experience, they're gonna look at churn, which is how long are these clients staying with you. They're gonna go, oh, I see you have a subscription model, and it's part of the model is a structural capital, and the processes of to have to make sure that it's great. They care. I mean, they're gonna care more though about if the process is wonky, they could probably fix it, but they care more about how much retention you have with a clientele here with the customer capital. Because if you have a subscription model, but every month you're losing 25, 30%, and you constantly, have to get new people, versus you're retaining 95% of your clientele, they go, okay, great. All we need to do is put some growth in this and there's retention. It's sticky, right? And that's also going to show up in the financial statements, because what's going to happen is you're not going to have this fluctuation. You're going to have this amount of money that's consistently going across the board. And quite frankly, if you have retention from a subscription model and you're increasing in growth, it's going to look like this. Because you keep a lot of people and you're growing, that means your revenue and your net profit hopefully is growing. And if you structure the right, by the way, if you structure the right subscription model, the additional cost to add new clients in a lot of cases is minimal. It's usually from a marketing standpoint, the cost for marketing, but the long-term value of that client, especially if they're staying on, will be great, right? And then once we have this plan in place, we're going to harvest it. We have to manage value, meaning once we got this business where we are, we got to keep it where we are. People always say it's two different skills. It's one to earn money, the other one's to keep it. Same thing with value. It's one to gain the value of the business, not to keep it. I mean, we've known huge corporations, right, make billions and millions and tons of money, and we've seen where they have done everything to be successful and dominant, and they have fallen off, right? Look at companies like Radio Shack. Think of Sears. I mean, these are large corporations you never thought would have failed, right? So the more responsibility value is, it represents that you identified your value. We had talked about that, and identify the value. We identify the value. The next thing we do is we protect the value, right? So we identify the value of the company, we protect the value, Then we do what we need to do to increase the value, and then we harvest the value. Now that you've hit the value point, we want to see, okay, how are we going to pull this out from a personal standpoint? There are taxes involved. We got to think about that. How are we going to maintain the financials, my business financials, make that keep going, and also what do you do after from an exit planning standpoint? And I that's usually and I know for a lot of us now you go, oh, there's a million things I do outside of business and I have my work-life balance. There's a lot of times we think there's a million things you could do. But really, I've seen it where people go to retire and or they're looking to sell their business and they're confronted because it's all they're doing last 30 years and they do it 6, 7 days a week or 5, 6 days a week. And now you travel for 3 months and then okay, what am I going to do after? You want to really prepare that. Whether with a life coach or someone, figure out what that's going to look like. Then you want to actively manage the value process that leaves you financially independent and your business with many options. If you structure it properly, you'll have many options to sell this business because it's positioned to be sold. And you could just hand over the key and somebody else could take away and drive off in this financial vehicle. And at the same time, you will walk away with enough cash to get that done, right? So the big thing is if you start to think like this, the timing of your exit is irrelevant. Because once you structured your business and you've gotten it to this place, what will happen is when you go at any point, you could technically within, a short time frame, transfer this business, right? It also it preserves options. We never know if, a family member gets sick and we say, you know what, I'm going to spend the last year with this person because they're sick. And you know what, I'm done with this. Or it could be, I just want to take 6 months off from this business, right? Or, or even 3 months. Ask yourself, can you take off 3 months for your business when your business survive? What would happen to your business, right? It doesn't, and by the way, it doesn't mean that if you're not in that place, that's going to happen overnight, but you start to take these little steps. And before you know it, you start to have a business that is one, getting more valuable, and two, is allowing for more freedom. So just a bit of review. Identify the value, we protect the value, we build and increase that value, we go to pull from that value, but before we harvest it, while we're working on it, we want to manage and take care of all of those things beforehand, right? No, and again, I had Chanel there from before because I thought she was going to be here and other stuff, but she couldn't be, so anyway, so this is exit planning in a nutshell. And of course, there's a lot of moving parts. For some people, it may be new information. I'm glad I got all the questions that I got because a lot of questions were super important and things that needed to be answered and probably things people thought about. Are there any questions about, because I wanted to leave enough time. Are there any questions that you guys have for me about what you've seen so far or about your business or anything related to exit planning? So don't be sure. Okay. Yeah, go ahead, Tamara.
Earlier, there was a great presentation. Thank you so much. I learned a whole lot.
Thank you.
So earlier you said, when we go to lending institutions,
Yep.
they are going to want to see some of these things in place. But is it fair to say, well, in your experience, have you seen lending institutions be willing to lend in order to put these things in place?
A lot of times, that's a very good question. A lot of times they want to at least know. It could be part of the process where you're saying, I'm doing this to put these in place, but they want to at least know that you're viable as is.
Mm-hmm.
Right? So, and again, it's not like a life insurance policy where, a lot of times it's black and white. It's a lot of times, a lot of people don't recognize, but when you go to borrow, it's a story. It always, if it was not a story, let's put it this way: there are reasons why a doctor who comes out of med school with $250,000 could go to almost any bank and get another loan for $200,000 without even an experience in starting this business, because they know that the context is, oh, you know, this person's a doctor, so historically that will be what it is. They already know from historical standpoint, this is what doctors usually make, this is what the industry does, right? If you're not a doctor, you don't have that context, you have to create that story for them so they could understand that. So you could go to them and say, listen, I want to borrow a certain amount of money. In fact, I'll tell you a perfect example. There's a business owner, and this business owner makes almost, that's it, about 300,000, about 300,000. They have been doing well, but they are at a bottleneck. They are so involved in the business that they have numbers are coming in, but they're working 6-7 days a week. They're the only people in the business. Do they have standards and procedures? No. Do they have all these things? No. They have good numbers. So what they approach is says, listen, I just need to borrow a certain amount for me to hire an assistant and for that individual to come in and give us the freedom to really expand the business. No, if they didn't have the viable, if they didn't have a viable business with the numbers they're doing, the bank wouldn't even consider it. But the bank goes, okay, let me see your number. Oh, you've been doing well. Okay, I see the numbers. Great. You know, you got to be at least in a viable position to position yourself that way in order to do that, right? So yes, they will lend you to do it, but you gotta give them some substance or something. Bottom line, I don't want to say they don't care, because they do care. Well, some do, but they just want to get paid by their money. I'm gonna keep it real. They go, I give you $100,000. I want you to pay, you know, you could take 100 years to pay this back. Quite frankly, that's it. You could take 1,000 years to pay this back. I just want every month that the money comes back. Because the longer you have that loan, and as long as you're making the interest payments, they're collecting and they're fine with that. What they don't want is for you to say, hey, I can't make this payment this month. Oh, give me an extra 2 months. Give me an extra 3 months. They don't want that. So what you have to do is present something that shows that this will be available, right? So yeah, the bottom line is, so I was speaking with a bank guy recently. He goes, a lot of people have good ideas, but it's just an idea. We don't know if it's going to work or not. We don't know how to substantiate that. Because go earn some money first and then come back to us, and then we have belief in you because you started earning money. We'll give you more money to grow that thing because we have proof that you're earning money. So we're kind of a bit long-winded, but tomorrow what it looks like is, sure, they'll lend you to build that thing out and increase the value for sure, but they just want to know, you got to show some type of viability in the first place.
Okay, awesome. Thank you. And then I had one other question. Is there a source, a database that you would recommend where we can go and look at how our competitors are doing in the industry, or just dive deeper into industry other than Stats Canada, please? Don't say
Yeah, no, I know that. I like business, again, I like business brokers. I like business brokers because they are buying and selling these businesses constantly. And when I speak to them, they're able to pull all these different data stuff, right? And by the way, this is why I say you may have to pay them, because this is like precious information for them. It's valuable, right? It's what you used to do to provide a valuation, and valuations cost like $3 to $5 grand. But I'm sure if you meet one and go, listen, I'm trying to build a business. Okay, how much is it gonna cost for me to sit? You tell me about my industry and give me some value drivers, get some sense of that. But 100% business brokers will have access. Business valuators will have access. I just mentioned business brokers because they're probably cheaper to deal with. Business valuator for sure will be, but they're usually accountants and CPAs, and they're going to charge you at a much higher rate, right? No, if you have a business that's doing well, I think you should just, you have the money, get the valuation, pay for it. If you don't have the money, you want a softer amount, especially you're below $1 million, a business broker has all that information at your fingertips. It's a profit. You log in and you have access to all the different industries, all different valuations, all the different competitors, where the industry is going, where the industry is moving from, what they like, and the pros and the cons of the industry. They have all of these stuff at their fingertips. So That's where I would say to get it from.
Okay, thank you so much.
You're most welcome.
Anthony, we did have one in the chat.
Okay, so Dwayne said, should I have this plan once I finish my business plan, or this should be already part of my business plan? I'm still deciding what kind of business I want to do. I like, here's what I like when your personal goal drives your business goals, right? So I think as a person, because what we often do is we have the business rule our personal lives, and it's so easy for that to happen. Where the business goes or what it does. Okay, the business requires me to do this. I think it's better if you have a personal goal, and to achieve that personal goal, the business is the conduit to which you do that. Meaning, it could be a financial goal. It could also be work-life balance. It could be satisfactory in terms of what you do with your day-to-day. It could be your purpose in life, all of that. I think the business should be a conduit to that. So I always say your personal goals should be first, and then you go, okay, to achieve this goal, these are the things I want. Oh, I want a business to be the conduit for that. Okay, if the business is going to be a conduit for that, this is what this business needs to provide me with in order for me to hit my personal goals. Why? It makes no sense. You have a, no, I don't make sense. Let's put it this way. Why would you have a business and you're doing all this work, and at the end of the day, it doesn't fulfill your personal goal? So you do all of this, and you go at the end, you go, oh, I don't have enough for retirement, or I can't leave. I want to leave the business, but I can't. Like, you got to be strategic about that. And I'm not saying it's an intuitive or natural thing to do, because I think what's more natural to do is that we love something, we find we want to start a business, we start a business. I think that's the most natural thing to do. But if you walk it through, you will recognize that at some point your personal values kick in, and you go, why am I doing this again? Like, okay, I'm 5-10 years in. I did the business to get work-life balance, and I'm working more in my business than I used to work when I had a 9 to 5. It's not even achieving your personal goals. So, why are you doing it? So it's better if you, again, I think the personal goals should be first, then you look to the business to help you achieve those goals and fill that gap, right? So and in terms of what business you want to do, there's a lot of ways to go about that. You want to, first of all, just make sure you get a product industry fit, and then what role you play in that. If you're going to be directly involved in a business, make sure your skill set and your passion. A lot of people say don't chase your passion isn't anything. I'll tell you what, though, two people in a business, they're very much invested and they're very much motivated to do the business. The person who is passionate about that business is going to beat the other person every day of the week, even if they're both working hard, because the passionate person is just going to be more involved. If I go to run an accountant, if I am an accountant, I'm not an accountant, but if I was an accountant and I'm accountant with somebody else, listen, sure, I'm going to do everything to feed my family and do everything great. This guy over here is going to do the same thing. I don't really like accounting. I'm just doing it. I'm working the 6. I'm doing fine. This other person who loves it. Every chance he gets, he's reading up all these different things. He's going to these conferences. He's doing all of these things. You know what's going to happen? People are going to see the passion in this guy and go, this guy's nuts, man. He's passionate about accounting. You should hear the guy talks about accounting like, how we talk about watching an exciting film. That type of enthusiasm is going to win over clients. And by the way, it's going to show in your work, right? So I think passion plays a role if you're involved in a business that way. You could just be a lover of business and you hire people. And I know fewer people start that way, but that's something to consider. Something to consider is buying business, or even buying businesses. Sometimes you could do, I don't have the time for that, but sometimes you could do, if I had to go back, and I'd probably just do a vendor tape out. Look at an industry that works well, that just going well. Look at people in the industry, let's take some legwork, who are not best in class, but making money, so they can't sell their business. And I would approach them and I go, listen, I'll take your business on, but I know you can't sell your business. You won't position it like this, but this is how it would position, being strategic. How about I just run this business for the next 3 years, and I pay you a certain amount of profit, and pay you, and this would be the purchase price over the next 3 to 4 years. You're not selling the business anyway. And in fact, I had a client that did this. She did it with a motel. During COVID, a motel couldn't sell. And so what she did was she approached the motel owner she did a vendor take back. She goes, I know you have a challenge selling this business. So over the next 5 years, I'll give you this down payment. And over the next I think it was like not longer than 5, I think it was like 10 years or whatever, I'll give you the profits for the payment. They go, great, because one of them, this older couple, one had a stroke and the other one was doing well, but he had to take care of his spouse. They were financially independent. They had money. They just needed this thing off the plate because one of the family member was sick, right? So she took over the business, didn't have to deal with the banks, didn't have to deal with the crazy interest rates. All she does know is a portion of the profit goes to that, so that's one option that you could absolutely take. But yeah, so to answer your question, how should I have this plan? I think you got to start with your personal goals, what you want out of life, what you want to achieve, and then see where the business fits into that. There should be already my business plan. Yeah, your business plan should be, my assessment at least, your business plan should be an extension of your personal plan. And by the way, part of your business plan should be how you're going to exit that business. Because by the way, you will exit that business. You're either going to exit it alive or dead, but you're going to exit the business, right? One way or the other. So how are you planning to exit this business? It might as well, if you can, exit and make some money and sell it on the way out. Unlike a ton of people who haven't positioned themselves well and then just shut the business down, like a business that's making money, just shut it down, right? So I think you should plan your exit. Now, is the exit going to work exactly how you plan it? Probably not. Or maybe it will. A lot of people, when they build their business, they wanted to give it to their kids. But all the kids now want to be influencers and TikTokers and on YouTube, right? So you have a lot of family businesses where they're going, here's this million making, especially people who are in manufacturers. Manufacturers, they're having huge problems because a lot of them are built it from scratch, want to give it to their kids, and the kids are like, I saw how hard you work. I'm not planning to do that. You could sell it and do something with it, but I'm not being a part of that business, right? So what you want to do is plan your exit, and it may change over time. It may change over time, but one definitely plan a business. So have your personal, drive your business goals, and then kind of go from there. Was there any other questions? Other question? Oh, the recording will be available, and I have to. I'm going to email the slides right after. I failed. My apologies. I thought it was being emailed before, and so you should have all received all the slides now. And after this, I will email. So make sure that everyone gets the slides. Speaking of influences and the current generation, I find a lot of businesses want to be invested. In instead of maintaining 100% and have a solid exit strategy because of popular shows like Dragon's Den. All right, and shows are podcast. Okay. Okay. All right. Good question. All right. A lot of people, we're in this age where everything on social media drives everything. And I think it comes from, even before the Dragon Dens, I think it came from the Mark Zuckerberg's office. By the way, that model is not the model that most of us small business owners have. It's not the Twitters of this world. We are not building the Facebook. Well, I shouldn't say that. Most aren't. Maybe you are as an individual, but most of us are not. That model is counterintuitive to what we're talking about. Yeah, Dwayne, you could email whoever emailed the list. They got all the slides. They could send it to you. That model is driven on debt to increase valuation. It's very much a high leverage business model. Meaning, I identify this value of this thing, I pitch it, and then what I do is, for a long time, I drive no revenue. I only create user base. The user base and the data is where the value part of it is. So I build subscription. By the way, if you notice, all those models that build on that way, they build on subscription. They build user base. It's a subscription model, and that's why it increases the value. They have all these people coming in, and sometimes they don't even know how to monetize, but the whole point is I have a subscription, I just need to know how can I position this and push the money out. That is a very leveraged model. It's not your typical, I want to start a marketing agency, I want to start a roofing company, I want to start all these different things. And quite frankly, a lot of times, if you are not positioning yourself with that type of model, investors are not even interested anyway, because what they're interested in is the high multiples with high scaling and high exit. And in order to do that, because it's a completely leveraged situation, they need ownership. They can't give you all this money. They go, okay, here's the money, but I need ownership in this. And I need to be able to, if things go off the rails here, to take control of these things, right? There's no surprise somebody like Steve Jobs will get kicked out of Apple, even though he started the thing. That's what ownership does. So I think a lot of today's youth may think that that's what they want to go from things like Dragon's Den. But quite frankly, a lot of people like Dragon's Den are not necessarily going to invest in the typical just startup, unless, by the way, it's a model that's proven, and unless it's something that's already running and developing money. You know, so there's certain things that will make money. Yeah, if you have a trades, so this is how you could this is how you could position yourself in let's go deeper. This is how you could position yourself in a situation like a regular mom and pop store and get investment if that's something you choose and where it would make sense. You go, oh, I want to start as a plumber. Okay, you start. You go, I'm starting a plumber. You go to investor. I don't know. Most investors, okay, dude, yeah, I'm not gonna invest in your plumbing business. Like, how fast are you gonna scale this and get it going? It not make sense. So you go, it's your just little plumbing business. I have better things to do with my money. Aha, but you go this. I have this model, I have the system as a plumbing company, and this is how it works. Then you go, and this works in a fragmented segment. You go, look at all the 30, 40, 50 different plumbing companies all around here. I have a system that works well. I want to partner with you, and I start to buy each of these companies, the small companies, and make them into a bigger company. That's where you build and grow by acquisition. And that they'll be interested in, because what that allows for is a strategic purpose, a strategic purchase. And when you purchase strategically in a fragmented sector, the valuation goes up. So if you have one plumbing company, but you acquire another, that's 2 and 3, the value of them together as 3 is higher than the value of them independently. And you may need the capital to do that. And because you need the capital to do that, they will go, okay, this is great. And I see the valuation portion of it. And then once you have the system, they're just going to keep knocking on the doors at all of these. And before you know it, you're going to have one of the largest plumbing companies in GTA or wherever. And then you could probably either deliver better services or beat people on prices, or just over time beat them on marketing, because you're just becoming bigger. That is one way you could take like an ordinary mom and pop type of situation and get it to be something bigger than that. But I think a lot of that's driven to, yes, I think show like Dragon Den is one way you bring people, investors in. Tech and software stuff is another way to do it. And a lot of times, by the way, it's driven by people like the Mark Zuckerbergs of this age. Just to confirm, I'll get all the slides. Wait, or do I connect? I think they email the slides out. And if you can't get the slides, you can email me and I'll email it to you. Oh, where can we learn about exit? Okay, so I know somebody asked about podcasts. Subscribe. Okay. One person that I find to be good with purchasing business, there's this woman, her name's Cody Sanchez. She's on YouTube. But who I think is phenomenal is a guy called Roland Fraser. I buy all his books. I buy all of Roland Fraser's books. He also has a podcast called Business Lunch, I think it's called. This Roland Fraser. His books are cheap too. Like, his books are cheap. And when you buy the book, you also get a course, which is great. You buy the book and you get a course. And of course, the reason why he does that is because he has a course offer that's like $30,000, $40,000, because he gives away a lot of value. But if you work with him in his group, you pay $30,000. He'll walk with you and help you buy businesses and things like that. Roland Fraser stuff, excellent stuff. He has a book called Business Wealth Without Risk. It's a great book. And then the other book with everything that I spoke about is everything I teach and I talk about, because it's called Walk into Destiny. And this is by Christopher Snyder. So Roland Fraser and Walk into Destiny by Christopher Snyder. 11 actions an owner must take to rapidly grow value and unlock wealth. Those two books are great books. You start there, that's like more than enough information. Roland Fraser book and this book are two great standpoints. But listen to Roland Fraser's podcast. It talks about marketing, valuation, buying businesses, selling businesses. It's all good. My goal is I have 3 more books I want to write. I have another, one of which being a business owner book. Because a lot of these books are all written for the States. So what I want to do is write something for Canada that I could talk about what it exit and tax stuff in Canada and all of that. Either the end of the year or top of the year next year, I want to write it. I just want to make it simple and digestible because some of this stuff can be pretty heavy. But by next year, I'm pretty confident I'll have an exit planning book that I will have written. Thanks, Tamara. So I see we're 1 minute over. Listen, hopefully this was helpful. Listen, even if you're just starting your business, do not neglect this. The folks who are doing, and Daniel Priestley is also not a good guy. He has some good books. But for exit planning, the people I refer to, they're the best ones. A lot of people get into business still trying to find themselves. But here's what you need to do. You need to go in with a long-term, you need to get into a long-term aspect of where you're going now and where you want to go. And it becomes a map that guides you on your path. Hopefully this was helpful. See you guys next week. Next week, we're actually getting into the capital. We've laid out all the framework. We're talking about raising capital, what the bank looks for, numbers, ratios, all that stuff. It's next week. You want to be here next week. See you all. I hand it back over now to Alia.